Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me is Phil Mackintosh, Chief Economist at Nasdaq, for an update on the latest COVID-19 news, the U.S. and global economies, and how investors are reacting as we make our way back to a new normal. And Phil, seeing a sell-off today, not too much of a surprise considering the run-up in all-time highs that we've seen in certain major averages. But this is also coinciding as the U.S. surpasses 2 million COVID-19 cases with the states reopening their economies.
Yeah, and I guess what we're really worried about is states like Texas and California that are seeing an increase in cases that we've talked about the last couple of days. Whether we're maybe already starting to see the emergence of a double spike in cases in America just because we're getting back to work too soon. I guess on top of that, though, really what's driving the markets down as well, I think, is just a lot of economists starting to get a little bit of a reality check on what's going on in the markets. And the Fed comments yesterday where they're quite willing to hold rates near zero until 2022 and just expecting that unemployment will remain high and that it'll take years to get fully recovered from the coronavirus slowdown is a bit of a reality check to people, I think.
Yeah, and I think if we take a look at our first chart here, the speed of the recovery, it's not the V shape that they thought it might have been, and getting back to normal might take a little bit longer than previously expected.
Yeah, and we've been talking about this as well. There's a lot of evidence in China that shows it's going to take a lot longer to reopen the economy than it is to shut it down. Obviously, airlines are one of the most significantly affected by the coronavirus. And so you can see that the level of activity fell to pretty close to zero, really, considering how much travel we used to do in America. It's been recovering, and that was one of the things driving the markets last week and this week. But even if you project the recovery rate in a straight line out, you're ending up with this getting back to normal mid of next year, which is around about the same time that people are talking about viruses having vaccines. So we're looking at a long-term recovery, even looking at the current rate of new airline bookings.
And with that, we're also seeing business investment falling, which is a concern because CapEx is what sets you up for future growth.
Yeah, and that's not surprising either, really, is it? With the amount of uncertainty, we've seen the CEO confidence indexes falling significantly a month or two ago. This is a data point that shows that CapEx plans have fallen. So it's not just that the consumers have stopped spending money on things like cars, although we might be seeing cars turning around pretty quickly with people wanting to drive to work, but a lot of the big expenses that corporates do look like they might be getting put on hold or at least delayed. And that's going to affect all the companies that do those services for those companies and build the things that companies do CapEx for. So that affects their employment and it sort of does create that trickle down effect that makes it much harder to recover from the initial slowdown.
All right, so if we look at our next chart here, analyzing the short-term pain versus the long-term gain, and New Zealand seems to have figured this out.
Well, New Zealand is the classic case of a really aggressive shutdown policy. They've got no tourism coming in. They had a pretty strict lockdown, but I guess partly because of how small they are as a country and how isolated they are as a country, they actually seem to have managed to eradicate coronavirus completely. They've had no new cases for over a week. And with that, when you go back to work, you go back to work with full confidence. And so even compared to the rate of return to work of Australia, which had some pretty good success shutting down their economy and getting rid of coronavirus, compared with a lot of Europe, which has got about a tenth of the new cases that they had at their peak, having no new cases, feeling like you've eradicated it, you can see in the behavior of people is getting them back to normal really quickly. And when you look at that compared to what we're seeing in other countries, especially in America, people are really still risk averse. They don't want to get on public transport. They don't want to take planes. They're taking a lot longer, as we discussed earlier with the airline bookings, to go back to normal because we still know that coronavirus is out there and it's a risk. So this is kind of an important case study. And unfortunately, it's a case study that we've talked about before with some 1918 data. So science and historians already knew that if you could lock down more aggressively, you could bounce back faster and better. And New Zealand seems to be proving that case all over again in 2020.
Yeah, in our final couple of slides here, Sweden's approach was the exact opposite, and that appears to be backfiring.
Yeah, even some of their leaders have said they might have made an error and backfired on them. You can see the human approach to what this risk is the household consumption has fallen significantly. We've talked before about how the Swedish economy looks like it slowed down around about 80% as much as some of the other Nordic countries around them. So even though they didn't lock the country down, um, the spending slowed, the economy slowed anyway because we're all in the same boat. We all have the same risks. We don't want to get sick, maybe die, and you can see the impact of that. And Sweden, as open as it stayed, has had a much higher mortality rate compared to other countries around it as well. So not only is it now struggling to get the new caseloads down to the zero levels of New Zealand would be ideal, but even a tenth of the peak levels, it's prolonging the pain, which might not have sounded like a bad idea a month and a half ago, but if it's still prolonging the pain in another month and a half, we'll be looking at New Zealand's example and wishing we'd all done that, I think.
I think so too, Phil. Thank you so much, as always, for joining me on Trade Talks.
You're welcome, Jill.
All right, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.